So let's see the example. And this illustration is based on indirect method. Firstly, cash flows from operating activities. So as we mentioned before, the operating activities will include um, current assets, current liabilities, and general expenses, kind of adjustments, revenues and expenses. So, and in indirect method, we have to start with the profit before tax. And this is the solution, and based on the book that we are following. So start with profit before tax. Say all the figures are in thousands, so 1,500. And adjustment for non-cash items. So as we mentioned before, so depreciation, we have to calculate the depreciation. The depreciation is available in the income statement. So 102. So 102 is the depreciation. So why we are adding it? This is the depreciation figure is positive. We are adding with profit. Why? Because we deducted depreciation before calculating profit. So the profit figure is actually lower because of depreciation. So the cash fees, as we mentioned before, the cash depreciation is not a cash transaction. Depreciation doesn't require organization to pay anything. So the cash is still in the organization, though it is recognized as an expense. So what we have to do, we have to add it back with the profit to find out actual cash. And profit on sale of plant. So this is being deducted from here. And adjustment for changes in working capital, the current assets and current liabilities. So increase in trade receivables, trade receivable increase, current asset increase means we didn't pay, we didn't trade receivables. So that means we didn't receive cash from the customer. So cash position is lower, so we have to deduct it. Same in inventory, inventory increase. So if we, when inventory increase, if you purchase more, and if you purchase more, cash is lower, so it need to be decreased, need to be deducted again. Decrease in payable. Decrease in payables means what? We paid payables. So if you pay accounts payable or trade payables, your cash is decreased, so you have to deduct it. Interest expense, if you paid interest, so what will happen? Interest expense is 20, so it's a 20,000, so it's adjusted with the profit, right? Because of interest, the profit is actually reduced. Now we have to add it back. So, and then if you adjust all these figures with profit, and finally you can see 309 is the adjustments net. So is after deducting these transactions with profit, finally we can see the cash generated from operations, operating activities or operations including profit is 309. Now still there are some activities regarding cash generated from, what is it, operations is 309. We have to adjust interest paid. There was no closing and opening accruals. So if there is closing accruals or opening accruals, we have to adjust those. So interest paid, we have to deduct this. This is what you paid. So cash decrease, obviously, as you paid. Income tax paid, so obviously 200. If you pay interest, your cash will decrease, and we have to adjust the accruals as well, because you may pay some amount from accruals, or you may have more accruals than before. That means you didn't pay. So we have to adjust those things as well. So the beginning or opening accruals was 190 and closing accruals is 170. That means the accrual decrease. When accrual decrease, if you paid more, that means £20 you paid from accruals, and current year you pay 200. That means 220 you paid. And yep, that's all about adjustments in relation to operating activities. So the net cash flow, net cash inflow or used in based on operating activities is 69. The second category of transaction that we are looking at is the investment activities. Investment activities, as I mentioned before, is relating to fixed asset, investment in fixed asset or fixed asset. So purchase of property, plant and equipment, if you see that the differences in the balance sheet, then property, plant and equipment increase, that means you purchase more. And if you purchased, that means you paid cash. So if you paid cash, then you have to deduct it from here. So it's negative. And proceed from sale of equipment. If you sell equipment, then you receive cash. If you receive cash, you have to add it back. All right, it's very simple. 241, the amount that you received back, you received from sale of equipment or sale of fixed asset. So the net cash used in investing activities is 319 because actually the used is not net cash in, it's just used because it's negative. And yeah, net cash used in investing activities is 319, and we got operating cash generated from operating activities 69. And cash flows from financing activities. As I mentioned before, financing activities is basically relating to long-term borrowing and capital transactions, and the interest and dividend in relation to those those borrowings and or capital. So proceed from issue of shares. If you issue share, that means you sold more share at premium or whatever. So is 300. If you sell more shares, that means you receive cash. So yep, 300 positive. Redemption of loan means you paid your borrowings, your loans. If you paid your loan, that means you paid means cash decrease, what you have to deduct it from here. And dividend paid, obviously, as you paid dividend to the shareholders, 120,000, 120, that means it's negative again. So the net cash flows from financing activities is 130,000. And if you adjust all this, 69, 319, and also 130, altogether you can see the net cash increase or decrease, positive or negative. Net cash flow from all activities is 120,000 negative. That is, outflows were more than inflows. And the cash position at the beginning of the period, the cash and cash equivalents at the beginning was 72, right? And cash and equivalents. So finally, what you will have at the end is the ending cash balance is 48. And obviously, you will see the ending cash balance given in the financial statement, that is in the balance sheet, is also negative or overdraft 48,000. All right, so this is how usually the indirect method, based on indirect method, we prepare a statement of cash flows. Evaluating the changes in liabilities and disclosure initiative amendments in Accounting Standard 7 issued in 2016, which provides entities are required to provide disclosures that enable users of financial statement to evaluate the changes in liabilities arising from financing activities. This is what we have to provide in details in the cash flow statement, that how the cash flows changes in relation to financing, because it's really important and what changes is being made or happen in the capital and long-term borrowings. including both changes arising from cash flows and non-cash transactions. So it may be non-cash, it may be cash, or whatever. It need to provide in details to make the organization's transactions very, very clear, particularly to the financial institutions who are supposed to provide loans to the farm. So how you can see the changes in liabilities, how you can evaluate this. And as you can see, this is say 2011 and this is 2012. So what is the changes made between the years? The long-term borrowings, how you can show it. So at in 2011, it was 22,000, and cash flows, that means negative cash flows. That means you paid. And if you paid your borrowings, that means your borrowings decrease. And then obviously ending balance should be 21,000. It was 22,000. If you paid 1,000, that means you have still long-term borrowings of 21,000. Short-term borrowings 10,000, and if you paid 500 out of it, and if there is any non-cash charges, or because of foreign exchange movement, or because of changes in currencies or whatever, so this is 200 increase. The amount can increase because of foreign exchange rates. So if this is the case, so 500 decrease from 10,000 and 200 increase, that means 9,700. And the total, what was at the beginning and what were the changes, and finally what remains at the end of the period, that is 2012, what is the long-term borrowings or liabilities of the company, need to provide in details in relation to cash changes and also non-cash changes. Why it is non-cash changes? It is because of the exchange rate differences. If you borrow something, or if a foreign organization, for example, US company, invested or provided loan to a UK company, and because of the exchange rate differences between the pound and the US dollar, then in that case, if you require to pay more in terms of the loan that you have get from US financial institution, that you have to adjust that figure in your financial statement. This is why it is important to adjust, to recognize actually how much is your current liability. And based on this cash flow statement, what we actually can see, cash generated from operations actually recognize the interest cover, how much interest, and whether the organization is able to cover those interest based on their earnings, and also debt coverage, because they are supposed to pay or redeem the company's liabilities of the debt, whether the company would be able to or can pay its debt, and also cash dividend coverage. So you have to pay dividend, and obviously the mature investors, retail investors, want cash dividends importantly. So if where the organization is able to pay its dividend or not is being recognized by this cash flow statement. And also it recognizes or depict the company's future in relation to the cash flows, right? Where the organization is going, what's the trend of the cash flows, is it increasing or decreasing, and its capability and the liquidity position. And company can take some sorts of precautionary measure in terms of discretionary expenses. Say if the organization see that their cash flows is decreasing and they don't have enough cash to pay its liabilities or long term or any kind of debt, in that case they can reduce their discretionary expenses. The discretionary expenses actually mean the expenses that you can reduce without impacting or significantly affecting the operations of the organization. For example, research and development expenditure. So I don't like to do any expenditure for research this year, or I don't like to provide advertisement this year. I don't like to give any donation to any NGOs or any social welfare activities, because I am not in a good position in terms of my financial position. So this is what they can do. And also, cash flow statement recognize the working capital position. Right? So working capital is important because the cash position, if you have more working capital, that means if you have lots of cash in your hand, then the profitability of the organization is actually reduced because the cash is remain idle in the organization. So it's important to make decisions. So if you have more cash, then the organization can try to invest somewhere, or uh, from where organization can get some sorts of benefit, like get some interest or profit earning capacity can increase in that way. Evaluating the investing activities and how the investing activities can change. It's very simple. It's very straightforward that the investing activities is changes because of purchasing or replacing any fixed asset, or expanding a fixed asset, or expanding expansion of the business. Right. So if you expand the business, if you open a new branch, if you purchase more fixed asset, or if you replace an old technology with a new technology, in that case your investing activities will change. So those are the things that we need to cover in under investment activities. And financing activities, so it recognized to what extent the investment or how the organization's properties has been invested or financed. But obviously, the cash flow statement doesn't provide any details of the policy, or the financing risk, or something else. It's not a statement which provides those details. For those details, we should look at the notes and the balance sheet actually. And also, it doesn't assess whether the company would have done better to provide finance by improved control over its assets, or working capital reduction. It doesn't assess that as well. So we should be aware of the weaknesses of the cash flow statement, what cash flow statement can provide and what not. There are some interesting discussion and some of the points for your thought. So do you agree or disagree with the following statement? The cash flow statement is the link between profitability and a viability. What do you think? Do you agree or disagree with that? So the answer is yes. You should be agree. You should agree with this statement because cash flow statement recognize some sorts of what's the profitability of the organization, what's the quality of the earnings or profitability, and if it has lots of cash in hand, then profitability will decrease. If it has less cash in hand, then the viability would be impacted. So the viability and profitability has some sorts of linkages with the cash flow statement. And secondly, all companies should be required to reporting using indirect format. What do you think? As we mentioned at the beginning of the lecture, no, we should disagree with this statement. This is an option to the firms, to the companies. They can use either direct method or indirect method. It's not compulsory to follow indirect method. So most of the companies, though, they follow indirect method, but they can, if they wish, prepare their cash flow statement in direct method as well. Next, the format of the cash flow statement should be left to the discretion of the management. Do you agree? No, it shouldn't. If they follow a direct method, they should follow that format. If they follow indirect method, they should follow that particular format. If the format is in discretion or choice of the organization, then the statements will lose its comparability. And obviously, in according to accounting standards, so we have to follow that particular format to make it more comparable and usable and understandable to the users of the financial statements. And finally, the requirement to standardize the cash flow statement format indicates a lack of trust in management. What do you think? So as we mentioned in the previous point that organizations should follow a particular format. Does it mean that um, it does it indicates that we don't like to trust or lack of trust on the management? Obviously not. It doesn't indicate the lack of trust on management. It's because of the comparability, it's because of following the standard, a particular approach. This is what it means. It doesn't mean that lack of trust on management. It's not about trust, it's about the or is about the usability, understandability, and kind of as we mentioned before, is the comparability between the periods, between the farms and some sort of more thing, something like that. So it's not about trust. It's not true. It's not. We should not agree with this particular point. So that's all about today's lecture, and these are the review questions that we would like to discuss in our seminar. And as usual, we will have a Kahoot quiz, hopefully. So thank you very much for watching, and see you on the seminar.